Hi everyone, welcome to Properties with Victory, your trusted space for everything real estate, where we make property simple, clear and easy to understand. Have you ever wondered what really happened when someone stopped paying for their house? It's something a lot of people avoid thinking about, but it's important to understand, especially if you are planning to buy a property through a loan. In real estate, that situation is called foreclosure. And in this video, I'm going to break it down in a very simple way, so you fully understand what it means and how it works. So let's get into it. Foreclosure is simply the process where a lender, usually a bank or a mortgage institution, takes back a property when the borrower fails to repay their mortgage loan. In very simple terms, if you borrow money from the bank to buy a house and you stop paying back that loan, that entire process is what is called foreclosure. Now, let me walk you through how this usually happens step by step. A buyer takes a mortgage loan from the bank or a mortgage institution to purchase a property. Everything is documented and both parties agreed on repayment terms. This could be monthly or yearly payments over a certain period of time. At the beginning, everything might go smoothly, but then at some point, things might change. Maybe the person loses their job, or their business slows down, or they face unexpected financial challenges. Because of this, they stop making their mortgage payments. Now, this is where many people get it wrong. The bank does not just show up one morning and take the property immediately. There's usually a process. The borrower is first given warnings. This can come in the form of reminders, notices, and sometimes even a grace period to settle the outstanding payments. The goal at this stage is to give the borrower the chance to fix the situation. But if the borrower still fails to pay after all these notices and time given, the bank then moves to the next step, which is taking legal action based on the mortgage agreement that was signed in the beginning. After taking possession, the bank typically sells the property, often through an auction or direct sales, to recover the unpaid loans. Now, let's talk about why foreclosure happened in the first place. It usually happens because of loss of income, unemployment, poor financial planning, rising expenses, or taking a loan that is simply too large to manage over time. Sometimes people are optimistic when they take loans, but life happens, and when income becomes unstable, repayments become difficult. Let me give you a simple example so this becomes even clearer. Imagine someone, let's call him Mr. B, takes a mortgage loan of 40 million naira to buy a house. For the first few years, everything goes well. The property is fully in use. But after 3 years, he runs into serious financial troubles. Maybe his business crashes or he loses his main source of income. Because of this, he stopped making payments. The bank began to send notices and gave him time to settle the debts, but nothing changed. Eventually, the bank initiates foreclosure. They go through the legal process, take back the property and sell it to recover as much as the outstanding loan as possible. At that point, Mr. B loses the property completely. Now in Nigeria, foreclosure is not as fast or as common as it is in other countries. This is mainly because the legal system here can be quite slow and the process might take time to fully complete. However, that does not mean it doesn't happen. Foreclosure still exists and it is very real, especially when dealing with properly structured mortgage agreements with banks and recognized financial institutions. The key thing you need to understand is this. Foreclosure means losing your property because a loan tied to that property was not repaid. It exists to protect lenders from losing their money, but it also serves as a very strong reminder for buyers. And that reminder is simple. Always take on a mortgage that you can realistically afford to pay, even if your financial situation changes. Think of it like buying something on credit, a car, a phone, or any valuable item. If you stop paying, the seller has the right to take it back. Real estate works the same way, but on a much bigger level. Instead of a phone or a car, this time it's your house, and the consequences are much bigger. That's why understanding foreclosure is extremely important before you decide to take a mortgage or commit to any long-term property loan. At Properties with Victory, our goal is not just to help you buy a property, but to help you make informed, smart, and secure decisions that protect your future. If you found this helpful, don't forget to subscribe for more real estate insights made simple and easy for you to understand. And if you are considering buying a property through a mortgage and need proper guidance, feel free to message us. We will guide you step by step so you avoid costly mistakes. Properties with Victory is where your decisions are smart, secure, and stress-free.